Today is Exxon Mobil Corporation, ticker XOM. Over the next few minutes, I'll discuss my thoughts over the valuation of this company and its business quality. This company has a market cap of $446 billion, enterprise value of $455 billion. So you can see about $9 billion in net debt on this business, which is almost infinitesimal on the overall enterprise value. It's about $2 billion, or 2% of the enterprise value. This is in the oil, gas, and consumable fuels industry. And if I don't miss my guess, they are the largest publicly traded oil company in the world, perhaps besides Saudi Arabia's oil company. So they explore for produce crude oil and natural gas in the United States and internationally. This basically has upstream, downstream, and chemical segments. They cover the whole gamut of different oil segments: manufacture, trade, transport, sale, oil, gas, petroleum, petrochemicals, specialty products, all across the world. You can see 20,000 operating wells, and they're headquartered in Texas. Beta of 1.1, not significant. Share turnover, 108%, not really significant there. As we go down to the return on invested capital chart, you can see a few things very quickly. One, they only lost money in 1 out of the last 20 years. This is very important for 2 reasons. First, this is a good sign in general. If you can be profitable for 19 out of the last 20 years, that's a very good sign to be a positive quality, high quality business. The second sign is this is exceptional for an oil company. It's quite common for oil companies to have boom-bust cycles, and you do see cycles in their business. Go from 2002, 13% return on invested capital, they get up to 33%, they drop back down to 14%. But the significant part about this cycle from 2002 to 2009 is that over 7 years, they didn't lose money in any of it. At the bottom of these cycles, they're still making a profit. The same is true going from the cycle in 2009 to 2016. Although it bottomed at 3% in 2016, they were still profitable. Very good sign to see for a business like this. Now, COVID appears to be the exception, and COVID was an exceptional period of time. Never before have we had the whole world shut down and basically a lot of international trade just stop and ground to a halt, and that caused oil prices to go negative in 2020 for the first time ever. And so during a negative oil price era, it's not uncommon that an oil company would lose money. What's significant here is that they have managed to not lose money in every other of those cycles, and so that's actually a very good sign for them. Now, what I like here is that you have quite a few number of years trading in the double-digit range in terms of return on invested capital. Basically, every year from before 2014, they traded double digits. Not only that, 15% to 30% range is a very strong area. Now, the bad sign here is you've seen a general decline in the return on invested capital over time. They've been making investments clearly in lower quality businesses that are not earning as much of a high return on invested capital, or this could be simply exposure to those oil prices as oil has been held down over time. Now, you see a strong rebound in 2021, getting a higher return on invested capital than any year since 2014. That's a very good sign that in the future, in 2022, 2023, we should see these numbers continue to get back in the double digit range. And once you do that, ExxonMobil will become a lot more attractive. Now, when we look at our key statistics here, you can see that they are earning a double-digit return on equity, which is a really good sign, even though return on invested capital has averaged 8.5%. Now, generally, I would like this to be a 10% number, return on equity be a 15% number. One of the reasons this is actually not hitting that is partly because of what I said here. You've had some recent declines, and you're averaging in a loss that you wouldn't normally have. If this number breaks back above 10%, you're going to see where this return on equity trend towards the 12, 13, 14, 15% range. Now, it's not as high as you would normally like, but that's because they don't have nearly as much leverage as a normal company trying to push their returns on equity up above that. So something to be aware of, that they could do a slightly higher returns, but you can see that when they were earning in the past 15% plus returns on invested capital, hitting a 15% return on equity would be an easy metric to hit. And what's nice about that is if you do that, you're trading at a very attractive valuation. PE of 9, PE of 8 here is very attractive for a company that has been earning 15% returns on invested capital for well over half of the last 2 decades. Probably somewhere in the range of 2/3 of their operating period over the last 2 decades, they were earning very strong 15% return on equity, and I would guess, close to 20% returns on equity based upon these 15% plus returns on invested capital. So very strong returns. And if you can buy that while they're cheap, having a PE ratio of 8 or 9, that's a very attractive way to enter into the business. Now, The caveat here is these 10-year CAGRs. You have 10-year CAGR of declining revenue growth, and you can clearly see that 2012 they earned $451 billion in revenue, 2021 $276 billion in revenue. So the business is smaller today than it was back then. Now, some of this they might have sold some assets, which I believe they have. Some they've taken some write-downs on assets for places like Russia. I believe they've done that as well. So it's something to be aware of how the business is structured. But what you can see is that despite that, they've already returned to gross profitability of what they've been having for the last 7 years. 2021, $64 billion in gross profitability. They're also earning a higher gross margin in these recent years than they did even in 2012 through 2014, getting up to a 23.5% gross margin. You like to see that when you're trying to earn a very high level of profits for this business. But you can clearly see they are down from where they were a decade ago, which could be a justification for this valuation ratio, which is really what comes to play here for Exxon Mobil. You need to have an idea and an opinion on will they return to the past, because the valuation is cheap if they'll return to the past. PE less than 10 is almost always attractive if the business can grow. And all of these EV to EBITDA numbers are very attractive. They're in the 6 to 7 range. 7 tends to be a good marker for what becomes an attractive price. I like to buy PEs of 15 or less. This is almost half the target price of what I would try and hit. And so when you're getting prices like this, it can be very good, but you need to understand what the business is going forward, because in 2021, they reported $5 in EPS. You're trading at close to a 20 times PE based upon that number. And so when we go to the income statement, we're going to see it's really a trailing 12 months numbers, which are doing even better. And that's been due to those higher oil prices. So again, you kind of need to have an opinion on oil prices and where the sustainable level is going forward. But this has the bones of a high quality company and the structure of a very attractive valuation depending upon your layout of the future. If you're enjoying this video, hit that like button. Don't forget to subscribe. We're going to dive on more with the income statement. So, and this you can clearly see, of course, in what I was saying in the trailing 12 months. And what's very attractive for the trailing 12 months here is we're going to compare revenue to gross profit. Over the course of the last decade, they've clearly improved the business because they are turning $386 billion in revenue into $95 billion in gross profit, when almost the same amount of gross profit required $451 billion in revenue. So they've actually been able to remove a lot of cost from the cost of goods sold from this business in order to make it a much more profitable business. The gross margins here are substantially better than you were a decade ago. So it's a really strong setup for the future that you are basically matching, and you're exceeding your 2013 and 2014 numbers. And those were really good years. Again, let's look back here. 2013 and 2014, 16% return on invested capital, 15% return on invested capital. Once you start hitting those numbers, you don't need to hit the 2012 numbers. Just hit the 2013, 2014 numbers, and the company starts to get really, really attractive going forward. Not only is your gross profitability better, your operating profit is better. Look at this. And this is largely because they've removed SG&A from the business. At 2012, you had $13 to $14 billion in SG&A. Now you're operating at less than $10 billion in SG&A. You've removed cost from the business. So your operating profit on $386 billion in revenue is higher than it was when it was at $451 billion in revenue. That's the sort of setup where a decline in revenue is not a problem. And so you can see a very strong setup here. Now, they do have some other non-operating income, which is causing their pre-tax to rise above it. You know, this is very lumpy, so I would try and ignore some of this. This could be, you know, asset sales and various things like that. So you really want to ignore that number and focus on the operating profit line for this business. And what you can see is the trailing 12 months are beating 2012's numbers, and 2012's numbers were this 24% return on invested capital. This could show a skyrocketing in their return on invested capital that really sets up for good future returns if they can sustain it, which is why you're seeing this number of like a $12 earnings per share beating the entire decade here. Not only that, they have bought back shares. You basically have 10% fewer shares outstanding today than you do at the beginning of the decade. That's going to juice your return by about 1% per year due to those share buybacks. I always like companies that buy back shares. They have been very disciplined here. Not only that, I believe if we go to our cash flow statement, I'm going to jump past the balance sheet because I want to show the dividends. They've been paying a consistently growing dividend over time. even through COVID, they're paying a strong dividend. $10 billion at the beginning of 2012. They're now paying $15 billion out in dividends. It's a very large amount of dividends, and they're covering that with their cash flow from operations. So I'm going to come back to the cash flow statement, but I wanted to just show that they've been growing that dividend over time. You can see it here as well, going from $2.18 to $3.48, over a 50, basically a 75% rise in your dividend over the course of a decade, despite having dealt with this lower returns on invested capital in COVID. So this business is obviously still operating very strongly, even though they've had those concerns. One of the things that you'd like to see here, of course, is that they've not grown their asset base over time. $214 billion, $216 billion, basically flat on PP&E over the course of a decade. Now you have $12 billion in investments here. You have some cash. You have some long-term debt. Although I think what's happening, how is that working out in terms of their look-through? It's got to be something like maybe their investments are offsetting this. I said there wasn't that much net debt on this business, so I don't know how that's being calculated. Because when I just look at cash equivalents, you had $6.8 billion here, you have $41 billion in long-term debt here. So there are a lot of costs there. So it may be understating the enterprise value. You'd want to do a deeper dive on that by studying the 10K before making an investment. Retained earnings, growing, they're funding it a lot with retained earnings. Of course, you have treasury stock, all these buybacks that have been taking place. Let's see. Pension liability is something to be aware of. I do like that they've been declining over time. I'd want to check on their 10K that they've frozen the pension so that you don't have this growing pension liability over time. Deferred revenue has been decreasing. You have some capital leases. But overall, the business looks quite good in terms of the balance sheet not growing super quickly. They've managed that well during those declines. One thing that I really like to see is 2020 in COVID. You had a net income loss of $23 billion. A lot of this came from depreciation and amortization, which meant that they had positive cash flow from operations. Now, they were spending a lot on PP&E still. They were spending a lot on dividends. So they had to issue a lot of debt here, $20 billion in debt. But they've already bought back $19 billion of debt from COVID. So they've completely offset the COVID debt ramp from that. And you really like to see that also they kept buying back shares during that time. Very strong setup. One thing that's missing here from cash flow statement is you don't see shareholders stock-based compensation. I really like that they don't have a lot of stock-based compensation that's going to cause that dilution. Makes for a very strong setup here. A lot of companies have that line item because they're always doing a little bit of that, but you don't see that show up here, and that's a good sign. I like that they're doing those buybacks. Of course, you've seen the buybacks kind of die down over the last 6 years as the business performance has gotten worse and they've kind of had to focus on the dividend. But that's an okay setup. You're not doing a ton of acquisitions. I like that they're investing primarily in their own assets. That's a good setup as well. So I like what I see here. Exxon Mobil is a company that I have owned in the past. It's a company that I've recommended to people in the past. It's not a company that I have on my current watch list today, only because I'm not trying to buy companies dependent upon commodities. But even though it's not something that fits my current ideal of what I'm trying to look for from a watch list, in the past, this is something I've been very attracted to. I've written up Exxon Mobil before because I like the underlying way the business is managed. They've been managed to pay a growing dividend or pay a dividend every year for decades and decades and decades. And so I really like this business when I've studied it in depth. So even though it's not going to go on my watch list, it's one that I really like as a business. You have a very attractive valuation here at a PE below 10. Very strong setup for good future returns. If this recovery shows what I think it is that the current year, trailing 12 months, is more in the 15 to 20% range in terms of your return on invested capital, which is very, very attractive. And if they can recover back to this time frame, shareholders are going to do very well. Thank you for listening to this. Hit that like button, please subscribe, and if you want to check out this software using, it's quickfs.net. The first link in the description below is my affiliate link. You can get a free or paid account. I hope you'll check it out. Thank you for listening, and until next time, stop paying fees, start building wealth.